Welcome to the deep dive. Today we're really getting into exchange-traded funds, ETFs. We've sifted through a whole lot of material to give you a clear path to understanding these, well, pretty powerful tools for investing. Our goal here is to unpack what ETFs actually are, show you how their kind of unique structure works, and point out the benefits, but also, importantly, what you really need to watch out for as an investor.
Yeah, ETFs are quite interesting because they sort of blend key features from mutual funds and stocks. They give you that diversified exposure like a mutual fund, and most track an index passively, though you are seeing more active ones now. But the big difference, they trade on an exchange all day long, just like a stock.
Okay, that trading aspect sounds key. So let's talk about what makes them tick. What's this in-kind exchange thing? How does that creation and redemption process actually work?
Right, so this is pretty central to how ETFs operate efficiently. Instead of money changing hands directly between the fund and, say, a market maker, what happens is a designated broker actually gathers up the underlying stocks, a specific basket of shares that mirrors the ETF's index and delivers those shares to the ETF provider.
Shares, not cash.
Exactly. In return, they get a block of new ETF units. It's an in-kind exchange. No big cash transactions within the fund itself when creating or redeeming large blocks of units. It's quite clever, really.
Okay, so that sounds technical, but how does that in-kind system actually help me, the person investing in the ETF? What's the tangible benefit?
Well, there are a couple of big ones. First, it helps keep costs down inside the fund because the fund itself isn't constantly buying and selling shares with cash, which incurs trading costs. Second, and this is really significant, it boosts tax efficiency. Because the fund isn't selling stocks for cash frequently, it generally doesn't generate as many taxable capital gains that would have to be distributed to you, the shareholder.
So fewer surprise tax bills compared to maybe some mutual funds.
Potentially, yes. It allows your investment to compound more effectively without that tax drag. And third, this whole mechanism, along with arbitrage trading, helps keep the ETF's price on the stock exchange very, very close to its net asset value, the actual calculated value of all its holdings.
So you're likely buying or selling near the true value.
Oh, good.
Got it. Those are some strong points already. Beyond that structure, what are the other standout features making ETFs so popular?
Okay, yeah. For you as an investor, the big draws are usually, first, low cost. ETFs generally have much lower management expense ratios, MERS, than traditional mutual funds, even lower than many indexed mutual funds. Some admin costs get pushed to the dealer, not the fund.
Lower fees mean more your money stays invested. Makes sense.
Exactly. Second, transparency. Most index ETFs, especially, tell you exactly what stocks they hold, often updated daily on their website, so you know what you own.
Okay, clear visibility. What else?
And third, diversification and targeted exposure, but efficiently. You can buy one ETF and get exposure to, say, the entire S&P 500, instant broad diversification. Or you can get really specific. Want exposure just to biotechnology or maybe emerging markets? There's likely an ETF for that. It gives you precise control affordably.
That flexibility does sound appealing. But you mentioned different types earlier. Are all ETFs basically the same, or are there hidden complexities? What should we know?
That's a really important distinction. You've got your standard ETFs that track common indexes like the S&P 500. Then there are rules-based or smart beta ETFs. They track indexes but use different factors, not just size, to pick or weight stocks. But then you get into things like synthetic, leveraged, and inverse ETFs. And here you need to be very careful.
Uh-oh. Why careful?
Well, these often use derivatives like swaps. That means they don't always hold the underlying assets directly, which introduces counterparty risk. What if the other side of the deal goes bust? And leveraged and inverse ETFs, they aim for, say, double the daily return or the opposite of the daily return of an index. The key word there is daily.
Daily.
Yes, they reset their exposure every single day. Because of compounding effects over longer periods, especially if the market is choppy, their returns can be wildly different from what you might expect, like just double the index return over a month. They're really designed for very short-term speculative trading, generally not suitable for buy and hold investors.
Okay, that's a critical warning. So complexity is a risk. What other specific risks should listeners be aware of when considering any ETF?
Good question. A few key ones. Tracking error. This is simply the difference between how the ETF performs and how its underlying index performs. It's never perfectly zero because of fees, the way the fund might sample the index instead of holding everything, trading costs within the fund, stuff like that.
So it might lag its benchmark slightly.
It could, or sometimes even slightly outperform, but there will be a difference. Then there's concentration risk. If you buy a very specialized ETF, maybe focused on a tiny niche sector, it might hold only a few stocks. If one of those tanks, it can really hurt the ETF's value. Less diversified than you might think.
Right, so check how many holdings and how concentrated they are.
Definitely. Also, composition risk. Two ETFs might track the same market, say U.S. large caps, but if one weights by market cap and the other weights holdings equally, they'll hold different proportions and perform differently. You need to know the methodology.
Okay, understand the weighting. Anything else?
One more. Securities lending risk. A lot of equity ETFs lend out the stocks they hold to short sellers or other institutions to earn extra income, which can slightly boost returns. But there's a small risk involved. The borrower might default, or the collateral they post might not be sufficient if the borrower fails. It's usually well managed, but it's a risk.
Interesting. Lots to consider under the hood. So finally, let's bring it back. How do ETFs really stack up against the mutual funds many people are more familiar with? Quick comparison.
Sure. Key differences. Trading ETFs trade all day, like stocks at market prices. Mutual funds price once a day at NAV. Management ETFs lean heavily passive, tracking indexes. Mutual funds have more active management trying to beat the market, though index mutual funds exist too. Transparency ETFs generally offer more visibility into holdings daily. Cost ETFs typically win on lower expense ratios.
So flexibility, often lower cost, more transparency for ETFs. Mutual funds might offer active management or easier automatic contributions sometimes.
That's a fair summary.
Okay, so wrapping this up, what's the big takeaway for you, our listener? It sounds like ETFs offer incredible flexibility and efficiency. They've really opened up access to all sorts of markets.
They absolutely have, but, and this is the crucial point, they aren't all the same. You have to understand what type of ETF you're looking at, standard index, smart beta, or one of those complex leveraged inverse types, and know the specific risks involved before you invest, especially with the more complex ones.
So really do your homework. Thinking about these mechanics, the costs, the risks, how might that change how you approach your own investment strategy?
Yeah.
What stands out most to you about these vehicles that have become so central to modern investing? Something to think about.